All right, let's keep our eyes focused on the market reaction to the Fed's Beige book. We're heading to the trading floor in Chicago, where we've got Trading Partners co-founder and chief market strategist Bob Iaccino joining us now. Bob, good to be with you today. Let me get your take in terms of what action we saw, if any, following the Fed Beige book. It seemed a little bit more positive. I'm not sure, though.
Yeah, I think when you look at it for equities, it definitely was. It was a just hot enough Beige book report. You saw modest growth in most sectors. You only saw three of the Federal Reserve banks, Cleveland, Chicago, and I think it was New York, report entry-level wage increases. Otherwise, wage increases were really focused on skilled jobs, which is not anything new to those of us that watch the economy every day. So you're not seeing the inflation pressures coming out of the wage pressures or anywhere else for that matter, and that's reflected in this Beige book report. It was just weak enough to keep the Fed on the sidelines with really no question about that.
Really? Okay. Bob, it seems as though that this is just a continuation of maybe somewhat of a Goldilocks scenario. Is that the norm that we're now in?
Okay, so two things. Number one, my job is to kind of try and figure out where things are going to go, not whether things that are happening in the policy realm are right or wrong. When you talk about a Goldilocks scenario, I totally agree in terms of equity prices rising, which is really all that I should be thinking about. But when you look at the scenario, if we don't get continued earnings like we saw out of Alcoa, for example, who did better this week, if we don't see continued earnings growth, or rather a reversal of the earnings growth recession that we were starting to see, it's going to become very difficult to just buy on an easy Fed. Really, we're in a situation now where the Fed isn't going to raise rates any further. They're going to keep rates stimulative. Obviously, people are expecting that out of the ECB. They're expecting it out of the UK post-Brexit. So it's another easy money rally, but I feel like that's going to get long in the tooth if we don't see some better earnings numbers.
Okay, so we'll be watching the earnings very closely. Of course, we've got the banks tomorrow. That's going to give us a good indication in terms of how they're faring, what the business environment's like, health of the consumer, et cetera. But let me get your take on another item that everybody's focused in on today, which of course is the slide in the price of crude oil. Are we just range bound and this is going to be volatile, or where's the next direction for the price of crude?
All right, so that's an easy subject for me. What we're talking about is a new range lower. So I've gone from a very highly publicized long position that I started in May to switching that and going short when we get rallies. If today we see a close below 44.78, that's a trigger for another leg down for me, but I want to sell rallies up toward 45. My prior range was going to be somewhere in the range of 46 to 55. That has shifted down for me now from about 41.90, so let's call it 42, to about $47. So I want to sell those rallies in. When you look at it, the rally from April in crude came from stronger demand, and there's questions about that now. We had that big build in crude, but the big draw in distillates. The refineries are out of turnaround. They're producing distillates. Those distillates are not getting drawn out. So that's going to cause a glut in both distillates and crude oil, which could be that next leg lower. But this is not a new leg of a bear market in crude. It's just a lower range.
Okay, I want to just break a piece of news coming across the tape right now and also get your reaction to this as it relates to Brexit. And that is that George Osborne has resigned from the UK government. They have instead named Philip Hammond as UK Chancellor of the Exchequer. Bob, let me get your take in terms of the continued fallout or ripple effects from Brexit.
Well, we're not necessarily feeling it here, are we? Other than the idea that part of the reason the Fed is out of the picture, which I think is more of an excuse than a reason, is turmoil in the UK. So as that falls out, continues to fall out, as you mentioned, all it does for us is keep the Fed out of the picture and maybe give a reason to buy even if we get sort of stagnant earnings. When you look at what's going on over there, the amount of time it's going to take, and I'm sure you've talked to guests about this ad nauseum, we don't know what the deals are going to look like. Some people say they're going to have special nation status like Switzerland does. Some say they're going to be punitive. I kind of struggle with the idea that they worked so hard to keep Greece in the EU, but they're going to be punitive with the UK on the way out. It just seems counterproductive to me, so I don't think that's the way it's going to play out. We wanted to buy the Brexit dip. We continue to want to buy any dip if it's solely a Brexit dip, but we've got earnings now, so that's really what we're looking at.
Bob, bottom line for investors, is this an environment that you want to put new money to work in, or do you sit on the sidelines? Recognizing, of course, that you're a trader and you're looking at this day to day, but what do you think? Do you sit on the sidelines a little bit like a lot of money managers have been doing?
Yeah, I think it's difficult to figure out the trigger that's going to bring those money managers in. and you really want to be behind that trigger. You really want to be sort of timing it the right way, and I don't feel a lot of investors have the sophistication. Most of the time, I don't have the sophistication to time that exact moment when all the money managers come in. So that money is sitting on the sideline. You know, this is really a financial planner's kind of a question, but if you're retiring soon, you want to stay on the sidelines. If you've got time, you have to invest in equities. Over the last 5 to 7 years, bonds have outperformed equities dramatically, even on, especially on risk-adjusted returns. I don't see that continuing for another 5 years.
Okay, Bob, great to have you on the program today. Thanks very much.